there is another feature, and these are the strap lines. So usually what happens if you need, so if you are a French bank or a Japanese bank, which needs US dollar funding because your companies would require US dollar denominated loan to deal with another US company or just deal with the international market. In this case, the usual channel was that these banks are going to US money market funds, and the US money market fund will provide a short-term loan to this bank, and after that they are providing a long-term loan to their own companies. And whenever you have to renew this kind of a loan, the short-term loan, you just renew it from or with the money market fund. There are multiple money market funds in the US, practically I can say infinite, but a lot of them. So there is a huge diversity, and after that you just take their money. The problem is that in December of 2007, suddenly this US dollar, let's say, availability started to shrink, and since then, in many cases, what we can see that there is insufficient amount of US dollar. We can say that it's always insufficient, and the level of insufficiency is also changing, but the problem is that there is not enough. So somehow, money market funds in the US, they are not able to collect enough liquidity to serve foreign demand, and central banks realize that they have to do something. So in December of 2007, they created the first temporary 6-month agreement that the US Fed provided loan in US dollar to the neighboring central banks like the ECB, the Bank of England, Canadian Central Bank, Swiss National Bank, later on to the Japanese Central Bank, and also at the same time, to keep everything at zero, they were providing loans with the same maturity and also in the same quantity, specified that they exchanged it at this time, in their own national currency. In this case, it's much better because if you are using the swap system like this one, then you should not provide loans in from your own foreign exchange reserve. Because the traditional way would be that, okay, if my bank needs any kind of liquidity in US dollar, then I will just give part of my foreign exchange reserve to this bank, and after that they will use it happily. Just in this case, my foreign exchange reserve will shrink. This one is much more comfortable because in this case I can get US dollar liquidity immediately from the US, then US dollar, give it to my bank, then after that it's easily paid. And also I'm not indebted towards the US because I'm also providing them loans in my own currency, which is really good also for the US Fed because in this case they can also diversify their extended foreign exchange reserves, and also they can provide different foreign currency liquidity for their own banking system. And in this case, they are really short-term contracts. So when I checked the different, when I had to go through for years of swap contracts, it was quite visible that mostly they were providing overnight loans or 1 week loans. Sometimes it was quite rare that they provided 1 month, and I think that was in really rare cases that 1 month loan was created. Otherwise, it was just ultra short-term lending for the banking system. Otherwise, between the central banks, they did this temporary 6-month contracts. From 2007 until 2013, when they realized that this is nonsense, that these are temporary contracts, so they created a standby agreement, and until today they are doing this. So usually what we can see that when politicians are trying to create standing agreements, then they are fading within several years. When they are creating temporary things, then they stay with us for a decade or more. So a swap contract can be really useful, but in this case, these central banks must be credible for each other. So if they are not credible, then they cannot participate within this contract. So in many cases, smaller central banks or not that credible central banks or central banks with currency which is useless for the other participant, or when the central bank country has poor credit rating, then they cannot participate. So usually they can participate only in repo agreements, which means that they should have government bonds denominated in US dollars or euros. Then they have to sell it to the central bank, and in this case they can get euro liquidity, US dollar liquidity, whatever they need. So, as I mentioned, the first example was in the United States, and if we need a reliable indicator that is here scarcity of US dollar or not, then currency-based swap rates are necessary. So this is the indicator. Unfortunately, this indicator is not available from open sources, so only the Reuters database this is available. For me, I was really lucky because I wanted to study this since 2014. So when I was going through all the different instruments what the central banks did since 2007, I mean checking all the press releases from each decision from week to week, which was a wonderful. I think I was spending 2 weeks of my life on this job, but at the end of the day I was able to see that what happened. So that was necessary. And since then I was always thinking that maybe we should analyze or check what happened with these swap contracts. But unfortunately, there are not much data. So there is a small set of academic literature, and also there is an even smaller set of analytical job made by the central bank. So they are just take it as it exists. So in 2020, I had a really good master thesis worker. So when I was able to see that, okay, there is a potential in the thesis work, then we converted the paper to a journal article. And after that, let's publish in the scientific journal published by the Hungarian Central Bank. So it's a small journal, but still with nice paper. And this is when all hell breaks loose because we got really tough reviewers. So first, one of the requirements was that we have to include this currency-based swap lines, currency-based swap rates. And before of that, I had no idea that these things are existing. And where can I find them? So I was really lucky that at that time we already had this Reuters database. And what you can see here also that if they are negative, and mostly before 2023, mostly all of them were negative, except the Australian dollar, or British pounds. So practically all relevant currencies were in negative territory. So it was never solved until 2023, until we started to have proper inflation and proper interest rates. But even in case of Canadian dollars, still we can see that this is still issue. Or which one is Japanese yen? Japanese yen is still in negative territory. But right now, all the other currencies, even today, they are in positive territory, which means that right now financial markets are operating well, except they are falling by 10%. So so this is the proper indicator if we need one. And after that, I already mentioned this one. So that was the first USD swap line. Before 2007, there were also swap lines practically since the beginning of Bretton Woods system. So sometimes they did it, but the frequency was way lower. They just did it sometimes when there were market shocks, and it was not so internationalized. So practically proper swap line things between key central banks started in 2007, and also we can see that since 2013 they were converted to a standing facility, and also it was extended in 2010, so now central banks can exchange between each other their own national currency. So it's not just for US dollar swap, but also other relevant currencies. And as you can see, this is still with us. So, okay, in case of emergency, we can see that a lot of millions of US dollars were transferred between central banks. Doesn't matter it's about the 2008 crisis or the COVID crisis, but if you are checking the logarithmic scale, the lower graph, still we can see that it was never reaching zero, so it was always something. I remember, okay, after 2011, they were able to cancel the agreements for 3 months or 4 months. They were so happy that, oh, we don't need this anymore, so we are cancelling this agreement. And it happened maybe in January, and in May, then we had to come back. So it was liquidity scarcity again. So we can't say that, oh, the crisis is over. Come on, this is still with us. So, and even today, they have to step in and mingle. So right now, but we can see that, okay, in the past, central banks were like lender of last resorts. Now, market maker of last resorts on the bond market, and also lender of last resorts in foreign currencies as well, because they need to do that as well. So, their instruments were extended a bit. And if you are just checking the spike from 2020, we can see that it was visible from the perspective of the US Fed. So we can see all the assets which were hamstered in during or before the COVID and during the COVID, so they were even purchasing much more government bonds. So we can see that already the scale starts above 4 billion US dollars. So already they have a lot of bonds in their portfolio and also some loans, but mainly bonds. And after that, when they were increasing this bond purchasing activity during the bonds, the second quarter of 2020, then we can see that also swap agreements were increasing nearly by $500 million. So we can see that, yeah, it can be visible. Unfortunately, I have no data about the Swiss National Bank right now with you, but also when they were doing swaps, it was also visible. So sometimes they were doubling their foreign exchange reserves with swap agreements here and there. If you are checking that who gets the money, mostly it's the ECB. So what we can see here, that the blue one on the bottom is the European Central Bank, and after that, the second most relevant is the Bank of Japan. And practically we can see the Bank of Canada, so this is a narrow line, but we can see that the main financial centers, and also after the Bank of England is the orange yellow. But also they needed this money for temporary periods, so most of these actions happened for 2 months, and after that this is shrinking back, but still not disappears, just it decreases. Yeah. Then also obviously ECB needed British pounds because Irish banking system had to be consolidated and bailed out during 2000 and early 2010s. So, and since Irish banks are part of the Eurozone, but they were accumulating a lot of British pounds deposits, and also they were highly purchasing US government. It would be good if the US government was, but also they purchase securitized bonds from the US. So many toxic bonds were purchased by them, so that's why they had to be consolidated. And in this case, it was much better to create a swap agreement with the Bank of England. And ECB was providing euro, again as a loan to the Bank of England, and then it was a reciprocal loan backwards towards the ECB British pounds. And in this case, they were able to lend out these British pounds to Irish banks, which otherwise on market basis would not able to do this, or maybe they can do it just at way higher interest rate. So they wanted to avoid such a situation. And also Poland and Denmark and Hungary tried to step into this game that, oh, we need also euro liquidity as well, but in this case, ECB told them that no, you can get repo agreements. So if you have any acceptable collateral, so technically euro-denominated government bonds, then we will accept it, and then you can sell it, and then later only buy it, and yeah. So in this case, they were able to get also some euro liquidity, but this one was not that kind. And also we can see here Denmark. So it was not just for us, but in the region, but everybody outside the Eurozone, except the British, were punished. So if you are checking the official website, which is containing not much information, unfortunately, about this swapline network, then we can see this really nice figure that how euro liquidity is provided between different central banks. So we can see that also Schwedish Riksbank was able to step in. Later on, Denmark was also able to step in. People's Bank of China is a different potato. I will talk about it later because they had their own swap motivations and contracts. So yes, they have swap line, but their motivation is different. So not a temporary or short-term liquidity distribution, but much more like the internationalization of the renminbi was the motivation to create things like this. Yeah, so repo agreements nowadays still present, but this is much more like with the Hungarian Central Bank, the Romanian Central Bank, and also with, wow, Andorra has its own central bank. Okay. Yeah. Or San Marino has its own central bank. That's what I was thinking about it. So we can see that small economies and smaller economies still can be participate, but only with the repo agreement. So nowadays we can see only 2 member states of the EU which cannot still participate within the Euroswap contracts. I don't know why. Yeah. This one is quite special because when in the Baltics, so Estonia, Latvia, Lithuania, so we are talking about countries with several million people, which were separated and became independent after the collapse of the Soviet Union in 1992. So most of their banking system is practically part, so owned. So they are subsidiaries of Swedish or Danish or Norwegian banks, but mostly Swedish banks are operating their banking system. So domestic banks have a share of 5 to 10%. So they are absolutely dominated by the other Nordic banks, and in this case, when this economy started to face issues, because we know that Iceland was quite close to default because they were also a major financial hub. I can't say money laundering or tax evasion hub, but so they provided financial services for wealthy individuals and multinational companies, and sometimes they were doing some illicit funding. So when they needed euro liquidity, then Sweden, Norway, and Denmark started to provide them euro swap lines, even if none of these countries or economies are part of the Eurozone. So practically they started to lend out their own domestic foreign exchange reserves because they wanted to stabilize this banking system, and also they started to extend this to Estonia and Latvia and also Lithuania as well. So within 2 years, they realized that maybe it's easier if we are pooling more foreign exchange reserves and providing swap lines to each other, even if they don't have the necessary liquidity. And this is quite funny because Finland also joined, but they are part of the euro system, so this had to be accepted by the European Central Bank as well. And that was also quite practical because during the first half of the 2010s, Estonia, Latvia, and Lithuania joined the Eurozone anyway, so now this can go backwards because still Sweden or Denmark is not part of the Eurozone, but if they need liquidity, then now they can use the services of the small Baltic nations because they are part of the Eurozone. So this is really funny reciprocity between different actors in the region, but still this swap agreement exists, and also it even deepened the cooperation between these countries since then. So this is a really nice one. And also this is quite strange that in Central Europe, most of the banking system is also owned by Austrian, German banks, also some Italian banks, Belgian banks as well. But in Central Europe, nothing like this happened. So if you are checking the Czech or Slovakian or Hungarian or Polish or Croatian bank market, it doesn't matter. Even so, euro-denominated or Swiss franc-denominated lending happened or were dominant in Poland, in Hungary, and in Croatia during or before the 2008 crisis. And even 10% of Austrian loans were also denominated in Swiss franc, which is absolutely crazy. And but in this case, there was absolutely no support or anything from this Eurozone-related central bank or any cooperation between them. They created a completely empty agency and the cooperation thingy, but without any funds. So that was absolutely dysfunctional. This one is working, what we can see here. Also, Swiss National Bank wanted to stabilize the demand. Okay, the demand was absolutely stabilized because it was continuously growing. So they wanted to stabilize the supply for Swiss franc. So that's why they created swap lines with the ECB, also with the Polish and Hungarian National Bank. They had also a swap line, but in this case, in another currency was euro, so they were not accepting national currencies. But I don't know what happened, but in 2012 they were able to. So the Polish Central Bank was able to create another swap line, and in this case, Polish zloty. I don't know how or what the Swiss National Bank was able to do with Polish zloty, because I don't think Swiss banks would require any kind of liquidity in Polish zloty, but at least it was paying interest nicely. So they were able to do that directly. But after that, we have not much data what happened with this money later on. So if we would like to create any model, we had this beautiful paper. Okay, now it's, oh my god, 5 years old. So that was my first paper when I was able to use
vector autoregression and such modeling, but at the end of the day, if we would like to analyze something, still US dollar liquidity allocation are the biggest ones. So it's easier to analyze because we have data and this data is changing frequently, so it's much better or much more suitable for any empirical analysis or statistical analysis. Also, the question was that how can we define that which variables are affecting. So, okay, I was mentioning that we need US dollar liquidity, but which factors are corresponding to this liquidity need? So how can we say that, okay, this is relevant or not relevant? So first of all, what we were thinking that maybe lending. So overall loans provided by the ECB to the banking system will be relevant because it means that if ECB must provide loans in euros to their domestic banks, it means that they are not able to collect it on market basis. So already there is a discrepancy in terms of domestic lending, and if they are not able to do this in euros, then obviously they are not able to do that in US dollars. So any kind of liquidity scarcity, which was the first variable, that can be captured here, because in this case we were just taking that, okay, all the loans provided to the Eurozone banking system related or compared to the total liabilities of the ECB, so related to the balance sheet size. The second thing was this currency-based swap lines, not lines, rates. So currency-based swap rates, in this case it was 3 months data, because that was the first what I was able to find, and also that was quite liquid and changing nicely. So okay, I was dividing it by 100, and it's really good. Until it's negative, we can have liquidity scarcity. Also, return on asset. It's nice because if return on asset decreases within the banking system, then obviously we have some issues in terms of operations at the banking system. Also, we were adding the balance sheet structure of the European Central Bank, so how overall loans, securities are related to the foreign exchange reserve of the ECB, because in this case also we can see that if this number is increasing, then it means that they are providing more and more loans and also purchasing more and more securities compared to their safe assets. Nowadays, maybe I wouldn't combine this with the total liabilities in the bank, but let's check that. Oh no, oh sorry. Yeah, this is not the ECB's at all. That one is the ECB balance sheet, but this one is the Euro area credit institutions and all the non-Euro area liabilities. Yeah, so literally that how hungry they are towards foreign funding. Okay, that was my bad. So it's much more related. Yeah, and also we had crisis dummy in the Eurozone. So are we in crisis or not? And yeah, so we also needed some dummy variable to represent when US dollar liquidity was dropping to 0, because it would create disturbances in the regression, so that's why we needed an additional dummy. When it was dropping to 0, then this was dropping or increasing to 1, and in this case the vector autoregression was not collapsing completely. So what we can see here, is that, okay, allocated US dollar was obviously increasing in
2008 because this is when the whole thing was invented. And also the LSFX ratio from the ECB was also increasing because they started to provide more loans. So they became more active in terms of monetary funds. And in the second time, when the sovereign crisis became much more intense in the Eurozone, then we can see that, okay, ECB became more active again, but also they had to provide more foreign liquidity. And then during the last time, before COVID, we can see that again, ECB started to build up their huge portfolio from different bonds. But also at that time, it was not that necessary to provide a lot of liquidity in euros. Still, it was between 110,000. Okay, so it was between 100 million US dollar and 10 billion US dollars, which is a lot of money, but still lower in terms of scale. So we can see that they are completely parallel with each other, what is happening with the balance sheet structure or the external funding. But in case of serious shock, we will react. Also, AI assistant, come on. So, in case of return on asset, we can see that, yeah, obviously this will be negative if we have a global financial crisis and the Eurozone crisis, so obviously this will drop. And also what we can see here, and I mentioned already, and I was showing you that this base swap between the euro and US dollar, it was always negative. So even after they became more active to provide this liquidity, the motivation to provide this liquidity was that the key indicator was this variable. So that's why I was really happy, because this variable was suggested by the anonymous reviewer from the central bank, because now I can teach it. So it's way better. And yes. Okay. Last thing. So if you have to study any kind of impact of shocks between different variables, we need always this identification matrix where from the top, so from the shock direction, shocks are affecting variables in the different rows. So what we can see is that we have to create some kind of a hierarchy how shocks are affecting different variables, because this one here will create shocks for everybody. So this is the amount of allocated US dollars. So this will go through the whole system. It will affect all the other variables, because this reflects on that how much money was missing from the system, and it should be put back by the central bank. Also, we can see that this is also a global indicator. Nowadays, I would put this one at first, not the other one, but okay, that was my first paper with this method. So in this case, this is the global indicator. It's much better to put global indicators at first. Also, we can see that overall loans coming from the non-Eurozone territory in the bank. So now it's a bank-related thing. And also this is the ECB and this is bank-related ROA. Again, nowadays I would put the ECB before of this. So I would put it somewhere here, and the bank-related things would be in the last two cases. ROA, return on asset, is a good to be in the last place, because all the shocks coming from all the other variables will affect them, but they are not affecting anything. So there is not much feedback from the direction. Just at the same, this is quarterly data, so in the same quarter of year, they will provide feedback for everybody, but
otherwise not much. Yeah. Yes, we have liquidity statistics, lags. Yeah, so what we can see that 1.5 years is the overall procedure until it's reasonable to think about these effects, but it still suggests that it has a long build-up. And oh my god, they require this difference. Okay, this paper is so ancient. So at that time they were requesting different colorings for upward and downward confidence intervals. Nobody does this, but somehow they required it. So obviously results are significant only if the upper confidence interval, so this one and that one, is both positive or both of them are negative. But we can see that everybody is really happily positively significant in the first 6 quarters of years. After we are losing 95% of confidence interval, but still at 68% of confidence interval, this is completely significant until 10 quarters of years. Why 68%? Because central banks like this a lot. One of our papers was nearly failing several years ago because we were saying that, okay, we are also publishing this 68% because it's always published by central banks. So you can open any kind of review or report or forecast by central bank. They are always providing this one, and the reviewer was absolutely furious about this. So I have to even write a specific paragraph that we are doing this because all of these people are doing this, and still he or she was absolutely not happy. But we have to add this. The difference is that we are 1 standard error or 2 standard error distance away from the mean. Because at the end of the day, so this is the expected value here. So we can say that the amount of allocated US dollar will depend on the previous values of allocated amount of US dollar. So this is a self-reinforcing procedure. This is always happening in macro-financial or any financial variable that they have a memory because they are autoregressive process. So there is nothing new here, but this is just the expected value. So practically the line can be everywhere between the confidence intervals. Just it is highly likely that it will stay here, and it's less likely to go there. But that's why we have this error bar. So you have to be within that. But also we can see that these are really short-term effects. So I mentioned that US dollar base swap or currency base swap data is relevant because it can capture that, okay, what is happening within the market, but this is absolutely short-term feature. So we can see that this was only significant here at the first quarter. So immediately. If it was changing, then you had to react as a central bank immediately on it by putting out a lot of currency, which can be a problem because you have to negotiate with other central banks that I need this money, so you have to work really fast because otherwise your banking system will start to crumble and fail. So this one is still a problem because after that, in the second quarter, it lost all of its significance. So after that, it's not significant. Just you have an instantaneous significance here. Also, in the case of external liabilities, obviously, if you have one in the first and somewhat in the second quarter, still we can see that you need more of this. But again, these are just for 2 quarters. So within half a year, this effect disappears. And so that's why the build-up of external debt can be a problem for central banks because they have to always get the proper reports, they have to understand it. So this problem can build up really fast and can disappear really fast as well. And yeah.
easy monetary policy calibration, what we can see here. Also, ECB's impact. We can say it's negative, and it's finally we can see something which is at least with narrow significance, so at 68% confidence interval, it can be relevant for a year what they are doing, and at least this one is counteracted. So if you are more active with your lending and securities operations, so are providing a lot of euro-denominated liquidity for your banks, then they don't need as much money denominated in US dollars, which is funny. In case of ROA, so if we something like this, so this scissor related or I don't know, hedgehog shaped impulse response function, unfortunately this one is happening when we have some seasonality in the data. I'm always downloading seasonally adjusted data, so maybe this is a feature, not a bug, but in this case, the seasoning can be also, or should be tested. At that time, I had no idea because I was a bit happy that I can do this and it's working. Just after 5 years, I'm a bit more experienced on this view. Yep. And also, if you are checking the relevance, so variance decomposition of the data, we can see that mostly 90% of the relevance was coming from the variable itself. So it was really in the center process, at least third of it, but otherwise 25% of how much US dollar should be allocated within the Eurozone was coming from the external liabilities of the banks. Again, external liabilities matter. So if we have external debt, then obviously we need funding if we cannot do this on market basis. For me, which was surprising that the return on asset was so relevant. It was utterly useless before in case of the impulse response function, but somehow it has an increasing relevance. So that's, I don't know, surprising fact. But what is also quite strange that the Euro US dollar base swap had only 6% relevance. So, and I know that we tested different, so this is not just one result, we were testing 20 different setups, orderings, and so on, and mostly that was robust.